All right, let's get into it. We're about to break down the latest from a company you probably think you know, Energy Transfer. But you're going to see their story is taking a really wild turn, connecting that old-school industrial muscle with the absolute bleeding edge of technology.
So let me just start by asking you a question. When you think about what's fueling this absolute explosion in artificial intelligence, what pops into your head? You're probably thinking microchips, right? Or software, or maybe all that venture capital money. And yeah, those are all good answers, but the real foundation might be something way, way more basic.
Because believe it or not, the answer has a whole lot to do with thousands of miles of steel pipe buried deep in the ground. Yep, we're talking about a massive network of energy infrastructure. Just stick with me here because this whole story links a traditional energy giant right to the very heart of the digital revolution.
Okay, so to understand where they're headed, we first have to see how they're doing right now. So let's start with their latest financial report card from the fourth quarter of 2023. And looking at the surface, it was kind of a mixed bag. The results show this really fascinating split. I mean, look at the top line. Revenue absolutely crushed expectations by more than $1.7 billion. That's a huge number. But then you look at the bottom line, the earnings per share, which is really a measure of profit, and it came in a little short. So what this tells you is that a ton of money is flowing into the company, even if the short-term profits hit a few speed bumps.
But that huge revenue number, that points to the real story here. Their operational strength is just incredible. For the entire year, the company posted a record-breaking adjusted EBITDA of nearly $16 billion. Now, you can think of EBITDA as just a way to measure a company's core operational profit. So, despite a little bit of noise in one quarter, the big takeaway is that the underlying business is an absolute cash machine.
Which, of course, brings us to the next big question. What in the world are they doing with all that cash? And this is where the story gets really, really interesting. Because they are not just sitting on it, they're putting it back to work on a massive scale. Just take a look at their capital plan for 2026. They're planning to spend between $5 and $5.5 billion on brand new projects. And just look where the bulk of that money is going. A whopping 2/3 of it is being poured directly into natural gas projects. Another quarter is going to NGLs, or natural gas liquids. This isn't just a minor tweak. This is a huge, deliberate bet on the future of natural gas.
And they're making this big bet from a position of serious strength. I mean, their existing business is just firing on all cylinders. In 2023, they set new records pretty much across the board, moving more natural gas liquids, exporting more, pushing more crude oil through their systems than they ever have before. The machine is running at full throttle.
So let's look a little closer at where that money is actually going. You really have to understand the sheer scale of these new natural gas projects. This is not your routine maintenance we're talking about. This is about building the energy highways of the future.
Get this, just one project, the Desert Southwest Pipeline, the price tag for this one pipeline is $5.6 billion. To put that in perspective, that's more than the entire capital budget for a lot of other really big companies.
And what does that kind of money buy you? It buys you a 48-inch diameter pipeline that can move up to 2.3 BCF per day. That's billion cubic feet per day. And just to try and wrap your head around that scale, a single BCF of gas can power thousands of homes for an entire day. This one pipeline can do more than double that every single day. And they are not being shy about what they expect from this. An executive on their earnings call said, and this is a direct quote, that they believe this will be one of the better rate of return projects that we've ever built. Now, that is a really powerful statement of confidence from a company that has been building pipelines for decades.
And look, this isn't just a bunch of talk. These projects are already happening. The Hugh Brinson Pipeline, another one of these massive projects, is already about 75% complete. The first phase is set to be up and running in late 2026. The steel is literally going into the ground as we speak.
So who is going to use all this new capacity? This brings us to the big reveal, and it connects us right back to that opening question about AI. The customer for all this energy? It's changing, and it's changing fast.
See, there's a new wave of immense energy demand, and it's coming from three key areas: population growth, a comeback in manufacturing, and, this is the big one, the absolutely insatiable need for power from data centers. I mean, these are the factories of the 21st century, and they run on electricity. And a whole lot of that electricity is generated by natural gas.
And if you want concrete proof of this strategy, look no further. Energy Transfer has already signed long-term deals to supply natural gas directly to 3 of Oracle's data centers here in the US.
In fact, the first pipeline is already flowing. This is the direct physical link between the pipeline and the cloud. And this isn't some one-off deal. No way. In just the last year, Energy Transfer has locked in contracts for over 6 billion cubic feet per day of new pipeline capacity, specifically for what they call these demand pull customers. So utilities, manufacturers, and data centers that are just demanding more and more energy.
One of the execs really summed it up perfectly. They're not just chasing the data centers directly. No, they're chasing the power plants that fuel the entire modern economy. And that is the crucial point. They're building the foundational layer for this entire next wave of growth.
So what does this all mean for the company's long-term game plan? Well, it looks like a really careful balancing act between super aggressive growth and some serious financial discipline.
You can just hear the excitement in their own words. Management is clearly so bullish, they believe their massive network of assets positions them perfectly for the next decade and even beyond. They see a huge opportunity, and they are going for it.
But, and this is a really important but, that excitement is balanced with real discipline. They recently hit the pause button on developing the massive Lake Charles LNG export project. And why? Because they felt their money could be better spent on other projects, like these pipelines we've been talking about, that have a more attractive risk-to-reward ratio. They're not just chasing growth for the sake of growth. And this discipline isn't just a feeling. It's guided by clear financial targets that act like guardrails. They're committed to keeping their leverage, which is just a measure of their debt, in a really healthy, manageable range. And at the same time, they're aiming for steady 3 to 5% annual growth in the distributions they pay out to their partners. So it's a pretty clear formula. Balance that aggressive growth with real financial stability.
Which leaves us with one final thought. We started this whole conversation with AI, and we ended up with pipelines. What this earnings report really shows is a fascinating strategic pivot. So the question to really think about is this. Is this seemingly traditional energy giant, known for steel and gas, quietly building the physical backbone that's going to power the next great technological revolution? Based on their actions, they're betting billions of dollars that the answer is yes.